And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Monday, the best day of the week. Actually, it's the start of another week. Actually, just kind of get ready to wrap up the month of April. Then May showers right around the corner. And what is it? It's April showers bring May flowers. So May flowers right around the corner. And temperatures outside, of course, are very cool today, at least here in Houston. So enjoy it this week. So it's going to be very dry, very nice this week. And then God will turn the oven on starting in May. So yeah, the heat waves are coming. Just beware. A couple of things, just a little bit of house cleaning this morning. I am traveling starting after the show this morning. I will be back on Thursday, but don't worry. We've got great guys handling the show all week. John Penn, Danny Ratliff, Jonathan McCarty. So you've got basically everybody taking care of you for the next couple of days, keep you up to date on what's happening with the markets, everything that's going on. I'll be back on Thursday with Michael Leibowitz to catch up for the end of the week. And we'll get you, we'll have content for you every day this week, but I do have to travel for the next couple of days for an investment banking conference. Other than that, it's going to be kind of an interesting week. And we'll get into this in a minute when we get into the Before the Bell commentary. But we've had 6 straight days of declines, and that's a very long stretch for the market to sell off. And of course, a lot of this has been, I love media headlines, right? You got to come up with a reason why all this is happening. And we've been talking about this for a couple of months, that the markets were very overbought, they were extended, deviated from long-term means, and that was going to have to correct. And what we needed was some type of catalyst, something that nobody was kind of really expecting to happen. And despite higher inflation numbers, the market kind of kept going up, right? That wasn't the trigger. The market was just kind of feeding into that, strong employment data, etc. So all that was fine. And then, of course, Israel and Iran, nobody was really expecting that. And when that sparked up, that kind of started that reversal of sellers going, okay, I'm out now. And as we've talked about before, sellers live higher, buyers live lower. And so we've had this correction. And again, it's nothing that anybody should worry about. It's not anything that you shouldn't have expected, because we were talking about it for 2 months. But here we go. We're having a correction. And we're probably mostly done with it for right now. Doesn't mean we're not going to get more of a correction later this year, and I would certainly expect a correction as we get ready to head into the presidential election. It's going to be contentious. There's going to be a lot of, potential for, post-election riots and all kinds of stuff, right? I mean, it just depends on how this thing turns out, but there's a lot of risk around that election scenario come November. Wouldn't be surprised if we see the market sell off again heading into that election, just because of the unknown. You don't know, if Trump gets elected, what are you going to get? If all of a sudden there's a dark horse candidate that shows up for some reason, what's that going to mean policy-wise? And that's just stuff that markets don't deal with very well. And they kind of get out of the markets before that event. And then after that, then you get the kind of the year-end rally as everybody says, okay, now I know who's elected, I know what we're going to get, I know what the policies are going to be, so I can invest accordingly on that. So again, don't think that this volatility we're having right now is all the volatility we're going to get this year. We're very likely going to get a bit more of it before the election. Outside of that, this week we also have a lot, and again, I'll talk about the data with Michael Leibowitz on Thursday in particular, because we have PCE this week, which is the Personal Consumption Expenditure Index. That, my friends, is the inflation gauge that the Fed actually pays attention to. What we all kind of, maturate over the CPI index and what it's doing. The Fed looks at it, but the real important gauge is that Personal Consumption Expenditure Index, and particularly what's called the Trimmed Mean PCE. That's the inflation gauge that the Fed uses to drive their monetary policy decisions. That's this week. So again, we'll take a look at that data. What's it saying? And then we'll talk about it with Michael Leibowitz on Thursday in particular when I get back. So in the meantime, here's what you need to know before the bell. So as I said, 6 straight days of selling over the last 6 days. I mean, it has just been a complete washout. We've seen a very, very strong decline in the markets. We broke the 50-day moving average. Well, actually back up. We broke the 20-day moving average, took out the 50-day. Market didn't even breathe at that point, just kept going down. We're sitting right on the 100-day moving average as of Friday. That's a very, very long stretch of declines. As we've talked about before, you have these buying and selling stampedes. We are not likely done with this correction just yet. I would expect here to see a rally back up towards 5,100, potentially another retest of the 100-day moving average, if not potentially a little bit lower. So again, there is a probability here. I shouldn't say a probability. There's a possibility here of a market rally that we get back to kind of some level of resistance and then another leg lower before ultimately this sell-off is complete. That would not be surprising. Now, also, we could have just a rally that just goes straight back up and, goes back into kind of the bullish trend here for the next couple of months. But, again, a lot of that would depend on what earnings season is going to look like. And if earnings are better than expected, that will help the market begin to recover. And again, this week and next week in particular, we've got a lot of corporate earnings out over the next 2 weeks. About 80% of the S&P 500 will report by Friday after next. So again, if earnings are good, that's going to help this market rally back up towards its previous highs. Also, once we get through earnings season, corporate buybacks come back. And again, we're slated to have a record amount of stock buybacks this year. So once that returns to the market, that will be an additional buying power for the market once we get past earnings season. So again, we could have a bit of sloppiness here over the next couple of weeks, particularly. And again, we get this kind of rally back up towards the 50-day, maybe a retest of this 100, and then the market begins to recover as buybacks come into play. And that takes us into kind of the May, June period, which is the end of the seasonally strong period for the NASDAQ. So there is some kind of traditional seasonality still with the market as we start getting into summer. Now, once we get into July and then August, September, potentially another correction as we get set up, as I said, for the election. So again, this is going to be, potentially, and there's no guarantee of anything, of course, but potentially we could have a good bit of volatility, kind of sloppiness. Maybe this market has seen the highs right now for the year, and we kind of go a lot of, rally, consolidate, correction, rally again as we get into the election, and then at the end of the year, potentially set new highs for the market by, towards the end of the year, but maybe after November. Again, a lot of ways that this market can play out, but we have a few drivers for higher stock prices coming, which again, earnings and then the return of buybacks, which will provide a support for the markets. But again, right now, we are very oversold on multiple levels. And in fact, we haven't seen the RSI this oversold in quite some time. In fact, the last time that RSI was this oversold was back at the bottom that we had in November of last year. So again, just from a kind of a point of just being oversold, I'm not saying we're going to get the same type of rally, but we are oversold enough here for a decent rally coming off this low. So again, if you've been, and we've talked about this, if you've been wanting to buy some positions, we needed some type of correction here to allow you to put some money to work. We may be having that. But again, we'll see how today plays out. And if I get back on Thursday, we'll go through all the technical analysis again with you and kind of see how this week is shaping up. But that's what you need to know before the bell this morning. When we come back from the break, I want to talk a little bit about two things. One, there was an NFIB report out and really had a lot of data about what's really going on with the economy. Also, kind of higher for longer, which was something that Jerome Powell talked about on Friday. We'll talk a little bit more about that this morning. What's that mean for inflation and interest rates? So all that's coming up right here on the show this morning. Don't go away. More of the Real Investment Show coming right up.
Get daily investment you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. So, a couple of things over the weekend that we covered in the newsletter. So if you haven't read it yet, it's on the website now, realinvestmentadvice.com. Just go to the Insights tab, click on the newsletter link. It's right there for you. If you're subscribed, you get an email from it every weekend as well. But importantly, you know, the recent little uptick in inflation, which was not unsurprising because, as we talked about before, everything cycles. And so as you have a decline in anything, economic activity or inflation data, whatever it is, nothing goes straight down, nothing goes straight up. And so you're going to have, bounces along the way. And again, inflation come down very quickly from 9% to 3%. So not surprising that because of the math and year-over-year comparisons, et cetera, you see a bit of an uptick in it. And that's what we've seen going on. Again, nothing to really be overtly concerned about. But, obviously, people are concerned about that is like, oh my gosh, the Fed's going to have to hike rates more. And as we talked about before, that's not likely going to happen. And Jerome Powell out last week, actually giving a press conference, said, hey, we're still going to cut rates. We just may have to, it may take longer to get to that first rate cut, which is also not unprecedented, but said nothing about hiking rates. So there was a lot of concern about UBS saying, oh, the Fed's going to have to hike rates more, et cetera. But there's really no need for them to hike rates at this point because the impact of higher rates are weighing on the economy. We are seeing that. And when we talk about NFIB data in a few minutes, you'll see the impact of higher rates on economic activity, and small businesses make up about 50% of the economy. But market pricing, remember, had gotten way ahead in November. When we started this rally back in November, the markets were predicting 7 rate cuts this year, and the Fed was only talking about 3. But the markets were saying, oh, the Fed's going to have to cut rates drastically. It was just hope. There was no fact behind that. It was just an emotional bias, and it sounded good, helped support the rally for the market. But there was no functional data behind why the Fed would cut rates 7 times this year because there was no sign of an economic recession. And we've been talking about that for a good while. So now the market is having to adjust for fewer rate cuts. And just as the market was overestimating the number of cuts this year, they're probably underestimating the number of cuts now. So again, markets are very unpredictable. They tend to swing wildly in one direction or the other. But we have grossly declined the number of rate cuts this year. But let's take a look at inflation in particular, because since this is the headline CPI reading versus the core year-over-year percentage change, and we can see that little recent uptick. Now, core hasn't really upticked at all. It's still declining, just the rate of decline is slowing down. But, we're about 3.48%. And this is what's gotten everybody kind of antsy at the moment because inflation's is not continuing that decline. It's ticked up here. But again, in relation to how far we've fallen, it's a very minor uptick. And again, shouldn't be a surprise at all because, again, as the economy evolves, we still have good, strong economic growth right now. People are out spending money they don't have. So, when you have economic demand, you're going to have price increases. If I can sell something at a higher price, that's what businesses are going to do. And that's just a function of economic demand versus supply. If you had economic contraction, in other words, consumers were cutting back on spending and not going into so much debt to buy more stuff, etc., then prices would be falling because in order to sell something, I've got to cut the price to sell it. And again, that's coming because we have a big build in inventories. Take a look at retail inventories as an example. Those are very high. And again, once we get into the small business data here in just a second, you'll see a lot more of this. But in the short term, there's two drivers for inflation. In the short term, 1 month to the next, it is driven by changes in oil prices, changes in commodity prices, etc. And there's a very high correlation going back between commodity prices, oil prices, gold prices, etc., that all lead to changes in both the interest rate, which is a reflection of inflation, and economic growth. And if those are stronger, then interest rates come up a bit to match that, versus the underlying commodities. Now, why is this short-term impacts? Well, in the short term, commodities are the base product that are used in order to buy or to manufacture something to sell. So if I'm, let's think about something very, very basic, building a house. So in the short term, I buy a piece of dirt. I say I want to build a house here. Well, I can't live in the house. I've got to build it first. Well, in order to build it, I've got to buy sheetrock and lumber and carpet and nails and whatever, right? All the stuff that the roofing tiles, etc. Everything that goes into buying a house, those are commodities. So I've got to buy those commodities. Well, but even there's a further distance of that. In order to get lumber, I've got to go cut down trees, right? So there's somebody cutting down trees, making the lumber for me to buy. So there's these commodity inputs that go in the house. If there's a demand for that product, and there is a demand for housing right now, then you're going to have higher prices in the short term. So in the short term, commodities matter, and they matter a lot. But commodity prices go up, they go down, they go up, they go down over time, and that's just things that happen. Gold prices go up, they go down. They're commodities, and that's what happens to commodities. Commodities are driven by trading. What happens on the NYMEX? That's it. So if there's a speculative investment to be made because prices are rising, I think oil prices are going to go up. Israel, Iran, I'm going to go buy a bunch of oil futures and bet on the price of oil going up. Well, that drives the price of oil up. It's not really supply demand driven. Gold's another good example of that. So if seems to be a demand for gold prices are going up, I go to the NYMEX, I buy gold futures, and prices go up. And again, when that trade is over, it will all reverse. And this is why we have, oil's a great look in terms of commodities in general. Oil and commodity markets are very, very closely tied. And when oil prices decline, they tend to decline very sharply, much more so than other commodities. But they do track each other very closely. In fact, this chart is basically crude oil versus CPI. Crude oil has a very, very high correlation to commodity prices. Crude oil has a very, very high correlation to the ebbs and flows in inflation. It's just commodity prices. Again, short term, what drives it from 1 month to the next. Now, that's just the way commodities work, right? Commodities in general, they don't provide a yield. They have no fundamentals. It's all trading. So what if everybody's going long, price of commodities go up. If everybody says, okay, that trade is over, which will happen at some point, all those prices will come down. And that's why commodities ebb and flow over time. A lot of that has to do with economic strength and weakness. So as long as economic growth continues to come in stronger than expected, you're likely going to have a push higher in commodity prices. That will eventually change. And if you take a look at oil prices versus the rate of change in economic growth, the story becomes pretty clear. So the black line is GDP on a quarterly basis, and the red line is commodity prices. Taking a look, if you go back to, the 2009 financial crisis, we had a very drastic drop in oil prices during the financial crisis. And what saved oil prices at that point was we had this miracle of fracking that came along. And so oil prices went up because, oil was improving. And we could drill more oil, we could frack for it. And at the same time, the economy was also recovering because of billions upon billions of dollars worth of stimulus being put into the economy. Then so after that initial thrust higher, the economy stabilized. We went through a manufacturing recession and oil prices declined. Again, if I overlay commodity prices in general with this, if I overlay gold prices, it all tracks each other. So it doesn't really matter what commodity you're talking about. When we got into 2020, you've had a very, very big decline in oil prices and commodity prices in general. And in 2020, we hit the world with a economic shutdown and then a massive, massive dump of stimulus, which created a massive surge in economic activity. And not surprisingly, commodities surged. So you had this big reflation in the economy, which is for the most part stalled because economic growth is declining. Economic growth is still strong. It's not falling off a cliff at this point, but in order to have a reflationary trade from here, you have to expect economic growth to gain a significant amount of traction because you need the demand within the economy. So on one side of the coin, everybody's talking about how much debt people are having to go into in order to make ends meet. They're having to cut spending because they just don't have enough money to make ends meet because of higher costs. That does not bid into stronger economic growth. That's deflationary when that's happening. Short term, it's creating activity, but it's not sustainable. So you have to come up with your reasoning why economic growth is going to continue to accelerate in order to bid up commodity prices further from here. And of course, that feeds into the inflationary trade. Now, as I said, commodity prices are great. Short-term indicators of inflation moves, great short-term indicators, but there's a bigger component to CPI that drives where CPI will go over the course of time. And we're going to talk about that when we come back from the break, so don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of things here I want to wrap up on this conversation about higher for longer, which has become the kind of the market narrative. And unfortunately, that's not going to really be the case. The Fed is going to have to cut rates probably by the last half of this year, probably more aggressively once we get into 2025. And that's kind of always been my expectation. I've asked Mike Leibowitz several times, why would I cut rates now? It never made sense to me to cut rates now. Economic growth is strong, employment's strong. Why would you cut rates here? Everything's perfect. It's nirvana. Save your rate cuts until you need to cut it. So by the latter half of this year, we're going to see slower economic growth, and we'll see, other impacts in terms of employment, et cetera, and then particularly probably more once we get into 2025. And, so as we're talking about this, we have to talk about the drivers of economic growth and inflation ultimately. And if we take a look, economic growth and interest rates, which is what everybody wants to know about, right? So interest rates reflect economic growth and inflation. So as economic growth is declining and economic activity is declining, inflationary pressures will decline and interest rates will reflect that because, again, it's borrowing costs. And if I'm loaning money, I have to compensate for the current rate of economic growth, opportunity cost, inflationary pressures, because I need my dollars to maintain their value over a period of that loan. And so I have to compensate accordingly. And so right now, interest rates are about where they should be given economic growth and inflationary pressures. Now, once we get into later this year, that will begin to change. And there's a very high correlation. It's a 85% correlation between GDP, wages, and inflation and interest rate. GDP, wages, and rates and inflation. So if we just make an index, there's a very high correlation. So as economic growth, wages, which are declining, and as wages decline, economic growth will decline. Rates will decline because they are all correlated. And as a function, inflation will fall. So there's a very high correlation to that over time. It's not surprising. It's just, again, kind of the way the economy works. Right now, we're still reversing a lot of that M2, that money supply that we plugged into the markets. We're reversing that. And that's still got a long ways to go, but it is coming down. And as money supply leaves the economy, then economic growth is going to follow as well. And as a function of that, 10-year Treasury rates will fall by the end of this year. So again, that's just a function of the math behind what's going on in the economy. And when the Fed starts cutting rates in particular, inflation will fall. So as the Fed cuts rates, the Fed will cut rates in response to slower economic activity, and that will correlate with falling rates of inflation. And ultimately, when the Fed cuts rates, you'll see lower interest rates as well on longer-term treasuries. So again, that's just all kind of correlating together. So as we talked about, though, there's this one massive driver of inflation that is coming that is going to lead to lower rates of inflation. Again, commodity prices, we said earlier, that drives short-term, month-to-month changes in inflation. The big driver, which runs on a fairly big lag, is still coming. If you take a look at the breakdown of CPI, 44% of CPI is shelter cost. And Michael Leibowitz has talked a lot about this. We've written about this lately. But you take a look at energy, it makes up 7% of the index, right? So in the short term, it can have an impact. But longer term, it is going to be shelter cost and homeowners equivalent rent, et cetera, that is the big driver for inflation. And so if you take a look at CPI versus CPI shelter and CPI excluding shelter, you can see a much better correlation to how big an impact shelter is to that. And right now, inflation is elevated because the shelter costs have not come down yet. And if you take a look, if you strip out shelter cost, inflation's running around 1% right now, not 3%. That's how big of an impact that shelter is on inflation. But that inflation rate is coming down. So if you take a look at the shelter index, the shelter index is projected over the next 9 months to turn negative. And that's going to be a big drag. So there's about a 9-month forward run on trailing rents, effectively, and what shows up in CPI. So that decline that's coming in rents, again, we've got a massive oversupply of rentals being built right now, multifamily units, et cetera, all being built. So there's a big, massive supply of that. And so that's eventually going to show up in slower economic growth. Now, another side of this that we know is what's happening on the actual economic front. And just recently, the NFIB, the National Federation of Independent Business, published their confidence index, which fell to the lowest level in 11 years. So there's some very big implications of this. Remember, 50% of employment is driven by small businesses. 50% of companies basically have 10 or fewer employees. And so if their confidence is declining, that will affect 50% of the economy in terms of jobs. So, while we focus on Apple and Google and Tesla and these other big major corporations that are headline companies, when they have layoffs, they lay off, 10% of their workforce, makes a headline, right? Well, if I have a business with 10 employees and I lay off one, that's 10% of my workforce. It doesn't make a headline because I laid off one person, but it's still 10% of my workforce. So it's just pro rata numbers. So when you have 50% of businesses potentially laying off people, this is problematic for the economy. And again, if you take a look at the NFIB survey versus the 5-year average of interest rates, higher borrowing costs grossly impact those businesses. So historically, whenever that index has been where it is, you are nearing a recession. Now, again, it seems to be different this time because of all the money we've injected in the economy. Maybe we won't have a recession. But one thing we do know is that higher borrowing costs are impeding the ability of these businesses to operate, and tighter bank lending standards, et cetera. And that's leading to these small businesses not spending money expanding their business. So capital expenditure is very important, right, to the economy. And I'll explain that and understand why. But capital expenditure, plans of these small businesses to expend money to, open up another store. So you have a coffee shop on a corner, you're doing really well. And you go, you know what? There's another area of town over here. I'm going to go open another coffee shop and take advantage of that area of the business. Because in small businesses, people basically operate within 5 miles. So people generally won't drive more than 5 miles to a business, right? So whether it's a gym or a coffee shop, whatever. And that's why there's so many of them, because people like convenience. So as a small business owner, I have a successful business. I'm going to open another one, right? That requires capital. I've got to expend capital to do. I've got to hire employees. I've got to buy equipment, all that. There's no plans for that right now. Business owners are going, why on earth in this environment would I spend more money? And they're not. They're sitting on it. And this is important because CapEx plans show up as a very high correlation to real gross private investment, which is part of your GDP calculation. Now, so far, real gross private investment's hanging in there, right? But historically, when CapEx plans decline, and they decline as sharply as they are now, real gross private investment across the country will start to decline as well. And this is important because there's a very high correlation, again, between real gross private investment and real GDP. Real, it means inflation adjusted. If CapEx is falling, real gross private investment should follow, and should be followed by weaker economic growth. And we're seeing this in the data. And here's CapEx plans just versus GDP. You'll see the correlation. And you'll see the big gap right now between GDP and CapEx plans. Now, sure, this time could be different. Just historically, it hasn't been. We'll see what happens. But let's look at the top 3 concerns of small businesses right now. You say, what are the things that are concerning you the most? And I built a composite index out of these 3 concerns. The single biggest problems for small businesses right now: poor sales, percent reporting the cost of labor, and is this a good time to expand? And that answer is no. And so we're seeing that index rising, which means those are all bad things, right? We don't want that to go up. The higher that concern level goes, the worse it is for business views at the moment. But the biggest thing is poor sales, right? So let's go back to talking about inflation here for a moment and economic growth, right? We are a consumption-driven economy. So in order to buy something, I have to produce something first. I got to go to work, I got to produce something, get a paycheck, then I can go buy something. So in order to have that virtuous cycle in the economy, I've got to have higher wages that allows me to buy more stuff, that creates more demand for businesses, that they have to hire more employees, they have to pay more employee salaries, they have more buying power now, which increases demand, which leads to more growth, etc. And that's just a virtuous cycle and just keeps going and going. That's how you get stronger economic growth. That all starts with demand, right? So if I'm talking about demand, if I'm a small business owner or a large business owner, regardless, but if I'm a small business owner in particular, sales is all that matters. If I'm not selling something, I'm not hiring employees, I'm not increasing wages, I'm not doing any of that, right? I'm sitting on cash trying to figure out how to hedge my business. And right now, if you look at retail sales, both actual and expected, they are dropping sharply. In fact, they're some of the lowest levels that we've had since the 2020 pandemic and going back to 2008. So if sales are the driver of economic growth, that ain't happening. We'll come back, finish this conversation up real quick after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning, talking a little bit about the economy, expectations of economic growth, where's inflation headed ultimately, where's interest rates headed, all this ties together back to the economy. And if you really want a good indicator of what's happening economically, pay attention to small businesses because they're very economically important. As we were just talking about before the end of the break about retail sales, which is what they survive on, right, their sales. And their reality is that poor sales is becoming a much bigger problem for their businesses. And in fact, the actual and expected sales of businesses are declining sharply, as I told you in the last chart. And if we just make an average of those two indexes, which are the black line, you can see that they're at the lowest level that we've seen since really economic recessions and crisis. That certainly doesn't suggest that small businesses are doing great. And the reason this is important because if we overlay that average of expected and actual sales, it has a very, very high correlation to actual retail sales. Surprise, right? Shouldn't expect any different. And despite the fact that we saw stronger sales in March, everybody's like, oh, look how strong sales were in March. I just did a report on this Friday, but talking a little bit about the issue of retail sales. In fact, if you take a look at retail sales going back, February was stronger than March. February had Valentine's Day in it, right? Big shopping day. March had both Easter and spring break and was still weaker than it was in March. So really, despite the fact that everybody says, oh, these sales were so strong, on an inflation-adjusted basis, they're very, very weak, and that kind of correlates with what's going on with actual retail sales. And more importantly, the NFIB's concerns about small sales. And if you have poor sales, you're not going to be increasing employment. And in fact, if you take a look at their intentions to hire, which is that blue line, it's dropping sharply. So small businesses are going, I can't hire anybody. I'm not selling enough product to warrant hiring people. Now, despite and what's interesting is despite all of their optimism previously about hiring employees, they never did it. So the blue line is expectations. Are you going to hire anybody over the next quarter? Yes, I'm going to be hiring people like crazy. Next quarter goes by, they go, well, how many people did you actually hire? Well, I didn't really hire that many. right? And so expectations were just massively deviated from what they were really doing because real sales were never really all that strong. So despite all this hoopla about strong employment data, et cetera, small businesses weren't really pulling their fair share, right, in this case. But if we take a look at also, their expectations to raise worker compensation, that's dropping very sharply. And importantly, there is a very high correlation between raising worker comp and GDP. And so if the decline in raising worker compensation, their plans to raise worker compensation continues to decline, we're going to see slower rates of economic growth. And if you see slower rates of economic growth, that exacerbates the problem of poor sales, so forth and so on. And that is the problem that we have currently going on in the economy. Now, this is just some anecdotal data, right? But all of these, if you take a look at Bloomberg analyst estimates right now, economist estimates, they're expecting the economy to grow strongly this entire year. In fact, they're ratcheting up their growth rate for this economy to almost 3% for 2024. The data doesn't really support that, but could it happen? Absolutely. We wrote about last Friday about the impact of illegal immigration on employment, and that's been a big driver. We've seen a lot of foreign-born workers hired versus native-born, mostly part-time jobs. Full-time jobs are declining. In the short term, that certainly augurs for stronger economic growth, right? But if I can't have an economy growing strongly on part-time jobs, I need full-time work in order to grow an economy. And that's not happening right now. So that will all feed into this data by later this year. So all these expectations are likely to be disappointed as we get further into the year, unless, now here's the big caveat to all of this, unless we pass some big spending bills and we massively increase the federal input into the economy. So, over the weekend, we passed another, I forget what the number was, $96 billion or whatever, and foreign aid to send money to Israel and Taiwan, and another big chunk of money to the Ukraine. Not the Ukraine, that's the Walmart, to Ukraine. My text is picking up. So anyway, that doesn't help us other than it helps defense stocks, right? So defense stocks will do well. More money to Ukraine means Raytheon and Lockheed Martin sell more weapons. It was funny because the CIA director actually had to warn Ukraine to stop stealing the money. He says there's $400 million missing out of these billions that we've been sending over there for this war effort. Somebody's stolen. You know who it is, right? It's all the oligarchs are stealing. They're skimming money off the top. I was watching Casino last night with my wife. My wife had never seen Casino with Joe Pesci and Robert De Niro, Sharon Stone, just a Don Rickles. I mean, just a great lineup of a cast. And so we were watching Casino last night. And of course, this whole thing is about how the mafia has basically, ran Vegas. The mafia built Vegas through the Teamsters Union. And, so they're skimming money off the top. And that's all this is. So, we have this big grift going on. We send billions of dollars to Ukraine to fight their war. And they just, there's $1 billion. We skim 10 million off, 20 million, whatever it is. Everybody gets rich at the top, of course. And, then the schmucks go out to shoot at each other. So, but that's what's going on. And the CIA had to warn Ukraine to stop stealing the money. But that doesn't help us, right? That's not increasing economic activity here. So if we have to have another spending bill in order to see economic growth expanding sharply, we need another big spending bill here, like the CHIPS Act, like the Inflation Reduction Act, that inputs money into municipalities or public projects, et cetera, infrastructure. That would create stronger rates of economic growth near term and could reverse some of this data. Right now, I don't see any of those projects coming. So that economic data is more deflationary than it is inflationary. It augurs for slower economic growth, not stronger economic growth. And so all of this underlying, premise right now about inflation has some very strong headwinds to it as we get into the end of the year. Again, could we wind up with much stronger rates of inflation? Absolutely. But you've got to remember, inflation is solely a function of demand and supply. So you have to make the argument, if you're expecting higher rates of inflation, you have to make the argument for higher rates of demand. But if you have inflation, you have higher prices and wages are falling. So where's the demand going to come from? Supply and demand. That's all inflation is at the end of the day. So you just got to work on that premise. Again, however you want to argue, it's up to you. I'm just showing you the data. You can make your own assessments. You can make your own investment decisions. You're all big boys and girls, and that's what makes a market. It's just good to know the data when you're making those assessments about your portfolio and about where you're investing capital in the future. Again, lots of narratives. Always go back to the data because the data will make you right more often than not. Again, the data can change. And so it's important to understand data can and will change for one reason or the other. It could be better, could be worse. But that's just where we are right now. Okay. As I said, let's see where we got. A couple minutes left. Couple of things here as we get to further into the week. Like I said, we'll talk about PCE on Thursday when I get back with Michael Leibowitz. So we'll get into that data, what that data is suggesting. Because again, that's the big driver for the Fed in terms of monetary policy, et cetera, is when they look at inflation, they look at PCE. They do look at CPI, no doubt about it. But PCE is their big driver in terms of monetary policy. So we'll see what that says on Friday. Expect the market to bounce here. We're very oversold. And as we talked to, for a couple of months, we were talking about, hey, rebalance risk, cut some positions back, raise a little bit of cash, whatever it is you need to do in your portfolio. We're going to have this correction. So here's this correction. Use the next rally if you haven't done anything yet. And again, this is why this first rally will fail. There's what's called trapped long. So a lot of people were very bullish this market, got caught up in the sell-off, and now they're like, oh my gosh, I got to sell something because this market's falling apart, right? The panic headlines about the coming crash are already starting to fill my inbox, right? So use a rally to sell into. If you need to sell something, use a rally to do it. Don't kind of panic sell here. Let the market bounce here a bit. It will bounce at some point. Maybe not today, maybe not tomorrow, but it will bounce. And when it bounces, sell into that if you need to do that, because there's going to be a lot of trap longs that need to get out. And so you're going to get another bout of selling pressure that potentially drops the market back to retest support, forms a short-term bottom, and then you get a buying opportunity. But this first bounce is likely not your buying opportunity. So just be a little bit cautious here. We'll get a buying opportunity. Just hold on that yet. All right, that wraps up the show for the day. Again, remember, I'm out tomorrow and Wednesday. Be back on Thursday with Michael Leibowitz. But don't worry, we got you covered. John Penn, Danny Ratliff, the whole gang will be here to make sure that they keep you up to date on markets, earnings, all that's going on. We'll have some good conversation for you. I'll be back on Thursday. Reports will be out this week. Our blogs will be out, as usual, on the website, realinvestmentadvice.com. Our newsletter will be out this weekend. You're not going to miss any of our written commentary on the website, realinvestmentadvice.com. Also, be sure and like and subscribe to the channel. We'll certainly appreciate it. And we'll see you next time on The Real Investment Show.